Where is the Indian bond market headed? What kind of attraction that we are seeing on that front? Let's take this discussion forward with Lakshmi Iyer, CEO of Kotak Investment Advisors. Hi Lakshmi, good morning and good to be speaking with you. First of all, Lakshmi, the Indian bond yields, though that is falling, and believe that it is now hovering around those lowest levels since December 2021. Another 50 basis points of rate cut is expected from RBI. But with this, how much more the bond yields may fall further? What's the outlook on that front?
Yeah, hi, good morning, Srishti. So clearly, the Keasri mode in equity markets is getting, I would say, counterbalanced with the green platter that we are seeing on the fixed income side. And clearly, a couple of key triggers, just not the rate cut that we saw, but also the RBI minutes, which clearly revealed a more than consensus view in terms of continuing this path of easing. So if you actually draw a dove and hawk meter of the RBI MPC members, the tone is more tilted towards a dovish or a neutral outcome. That's clearly bond market supportive, of course, notwithstanding maybe near-term consolidation, but that's clearly, and plus the RBI open market bond purchases, including this month that is underway. I think all that is pointing out towards a sustained lowering of bond yields in the months ahead.
All right, but Lakshmi, let me just touch upon the spreads as well, because on the other hand, the expectations of a rate cut from the US, that has narrowed. And with that, the spread between India and US bond yields have also fallen. How one should read this for the Indian bond market? Will the lower spread really means that the lower traction for the Indian bond market going ahead?
So 2 points to note, Sushi, in the US Treasury yields are being sold by foreigners. And when I say foreigners, I'm referring to countries like China, Korea. Whereas in India, it is the reverse. It is the Indian domestic institutions and the pension funds, insurance companies, etc., which are supporting the bond program of the government of India. So I think that's something which we can't undermine. And secondly, if you look at the US narrative, very recently, some of the Fed governors have been singing a dovish hymn, saying that if the data starts pointing or looks slightly favorable, we could see rate cuts in the US as early as June. So I think while the bond spreads have narrowed, no two ways about it, but does that mean that incremental downward movements for Indian bonds may not happen? That's very unlikely, because we could expect even US yields to start heading towards the 4% mark, and currently we're at 4.35 odd percent.
Okay, Lakshmi, hi, this is Snehi also joining in and morning. Just want to understand how tariffs come into play here and how should we factor in that metric as well, because while the uncertainty around tariffs still remains, the global growth outlook is weakening. Many of the agencies have cut their global growth target along with India's growth targets as well. On the back of this and amid all the noise that we're hearing externally, do you still believe that India is poised to grow above the 6% mark for FY26?
So I'd say the reverse. The world is growing at about 3%, including or after accounting for the slowdown and the marked cut in the global growth outlook. I'd say even if 100% growth happens for India, we're at 6%. Though if you look at, and I'll take you back to the RBI policy, where the governor did mention that there are signs of rural and urban consumption pickup. So we are actually looking at fueling an inward-facing sort of sectors, pump priming the economy right now. And of course, the BFS, the banking and financial services sector space, or the interest rate sensitive space, and not so much so the external looking sectors which we used to hinge upon for our growth outlook. So yes, definitely we could look at probably some more slowdown, and probably the GDP growth may not be as what we have highlighted or penciled in, but again, one-eyed man in the land of the blind is still very, very potent. And as I said, even if we are at 6% plus growth rate, that's still 100% more than what the world is growing. So I think that clearly will be a critical factor. And mind you, the global tensions or the global frictions has been one of the key reasons why we actually did a stance change. And I think that's something which is very, very critical even in the months ahead.
All right, but Lakshmi, let me just touch upon the INR because that is seen to be appreciating or rather stabilizing now, and the news report suggests that the RBI's net short position is in USD has hit a record high in the month of January. Given that the dollar is now weakening, what's your expectation like directionally in terms of the dollar and the INR? Is there an upside risk for rupee?
So, the dollar index actually from peaks of 109 went down to almost low of 98. And now it's kind of in the 99 odd region. And with the fact that, it's already seen such a sharp correction, and Asian currencies, specifically, if you talk about INR, has also seen some appreciation. I think this is the time to take a little bit of a breather. Of course, RBI has done buy-sell swaps to ensure that they are ensuring no disruptive movements on the currency on either sides. At the current juncture, our view is that if the dollar or the USD INR probably goes up to say 84 and a half levels. At that point in time, we could see some sort of dollar buying happening. And conversely, if it goes past and depreciates beyond 85 half 86, there again, we could see some sort of stability measures needed. For now, I think the 84 half to 85 half 86 kind of a range should be something which we will see like a rupee and a half of sideways movement. We're not expecting anything materially disruptive happening on the currency in the very near term.
Take on how the RBI could, gauge the entire fluctuation that we're seeing in global currencies right now. But Lakshmi, also help me understand that, recently Indian bonds were also introduced in many of the global benchmark indices. You have JP Morgan, Bloomberg. FTSE inclusion is yet to happen. How do you read these updates amid the uncertainty, and will the bond related flow remain intact going ahead?
For sure, when there is a risk off and risk on kind of a sentiment, we've seen this in the past 12 months also, that fixed income returns have been, pretty positive experience for the investors. And the inclusions which have already happened, that is already leading to some sort of a benchmark hugging mode for foreign investors. The impending inclusions, as and when they happen, obviously we can't really pencil in a timeline for that, will definitely continue to be a strong catalyst. We also need to keep one thing in mind, that RBI has been conducting bond purchases, which also has acted as a very strong anchor for bond yields. And that is more to protect or ensure liquidity in the banking system, which indirectly obviously tends to support bond yields. So I think if I draw that entire band together, we think that impending inclusions also, as and when, it's not that it's going to be very near term, but when that happens, that will definitely propel yields lower.
All right, Lakshmi, we let you go on that note. Thank you so much for taking the time out and speaking with us and giving us a sense that what's really happening when it comes to the bond market. Thanks so much for that. But with this, viewers, it's once again time now to slip into a very short.
If you like this video, then like, share and subscribe to ET Now.